Welcome to Chapter 4. We're going to continue our travel over the steps of the accounting cycle for a simple service-based sole proprietorship, small business. And in this chapter, I'm going to introduce two main books of any business, which include the general journal and the general ledger. In reality, there might be the business might be using multiple types of journals and ledgers. So we could have purchases journal, cash receipts journal, sales journal, cash payments journal. We're not going to cover them in this class, but those special journals exist. In this class, we're just going to learn about the general journal. For the ledger, we will look later into the subsidiary ledgers. In Chapter 7, we will talk about the accounts receivable ledger, and in Chapter 8, I will briefly mention the accounts payable ledger. Right now, we're just focusing on the general ledger, and these are our learning objectives. I will introduce both books, we will define them, and then we will learn how to journalize or how to record transactions in the journal. The previous 3 chapters all lead to our ability to correctly journalize business transactions. We will build upon the knowledge that we learned in Chapter 3 about T accounts. We're still going to use those T accounts on a piece of paper. It's just a tool. T accounts and our business transactions analysis in T accounts is not considered to be an official part of the record. So we will use T accounts just as a tool on a piece of paper, and then we will use that information about types of accounts, debits and credits, and the amounts, and enter them officially into the journal. We will also prepare compound journal entries, and then we will simply copy, or we use the verb post entries from the journal to the ledger. And I will also tell you how to make correcting entries if we made mistakes in the journal or the ledger. So as I mentioned, we are going to continue our journey over the accounting cycle. This is the definition of the cycle. It's a series of steps performed each accounting period to classify, record, and summarize financial data for a business. The main outcome of any accounting cycle is the preparation of financial statements, because they are external documents used by investors and lenders and the IRS and other government agencies. And we repeat these steps once in accounting cycle, once in accounting period. And the suggestion, the recommendation that I always give small businesses is to repeat this accounting cycle every month. And we learned about step 1 and step 5 in Chapter 2. Then we learned how to again use step 1 with T accounts, and we repeated, reviewed financial statements in Chapter 3. And now we're going to be focusing on steps 2 and 3 of the accounting cycle. This is the focus of this chapter. So let me introduce the journal and the ledger. So right here you can see, guys, that in order to record transactions, we use 2 sets of books. By the way, that's why bookkeepers are called bookkeepers. They keep these 2 sets of books. So in the real world, we will always have source documents, and if you worked in any part of business, you know that a copy of every major documentation always goes to the accounting department. So the accounting department gets a copy of the time card that employees sign and have the hours of how many hours they worked, and that time card becomes the source document for our salaries. And we get a copy of the purchase order, and we get a copy of the invoice, and we get a copy of a check, and we get a copy of the sales slip or sales invoice. So we receive source documents. In this class, they will be given to you. You will often, not for every transaction, but you will be given some kind of source document, which is, again, it's the original source which gives us a reason to record the transaction. And also that's what auditors look at when they're trying to trace the steps, when they're trying to see, well, why was this transaction recorded, to prevent any possible fraud. And so based on the source documents, we journalize, meaning we input our transactions in the journal. And this is what the journal is. It comes from the French word jour, bonjour, which means a day. It's a diary, right? So you've heard, of course, about Wall Street Journal. So it's a diary of business activities. And I want you to think of it as a chronological diary. It's the official record of business transactions, and our data, which is transactions, are sorted in chronological, which means day-to-day order. And guys, it's a book of original entry, meaning this is the first time we are entering our financial information into the accounting cycle, because our analysis of business transactions, what we did with you in step 1, this is done in our head on a piece of paper, but now officially we enter our financial information, so for the first time. So if I make any mistake in the journal, then that error will go into all other steps of the accounting cycle. And guys, simultaneously, once you journalize it, then you post it to the ledger. You can see why companies automate their accounting practices and use software, because, you have to think about what you enter in the journal, but many programs, such as even QuickBooks, they do it for you. Posting, there's no thinking. It's simply copying the same information from one set of books to another, but now they're going to be arranged, sorted by account. So in the journal, all the transactions are sorted by date. In the ledger, it's a book of accounts. You can think about it as a folder with a separate sheet for every account, arranged by the chart of accounts, right? Cash goes first, and then receivables, supplies, and so on and so forth. Or you can think about it as an Excel file is the ledger, and then separate sheets, those are the accounts. It's the book of accounts, and we record the same transactions second time, but now we have them sorted by account, so we keep track of each account separately and know what their balance is at any point. So let's record transactions in the general journal. Now, the textbook is quite formally giving you all these steps. Really, chapter 3, you know your T accounts. Just draw your T accounts on a piece of paper or in your mind. When for some of us, if you're struggling with transactions, use a piece of paper. If it's easy for you, you can do it in your mind. I draw T accounts only for more complicated compound transactions. So number 1 and 2, we already know how to do. We did it in chapter 3. So make the entry in the T account form on a piece of paper and then transfer it in the general journal form. So here is an example of the journal. Look at the journal. Always enter the page number. It will be given to you, you don't start with page 1. It's only the brand new business. And you have the date column. So you put the year and the month. It's okay to abbreviate the month. We do not repeat the year or the month until it changes or you start a new page. So I want to see the year and the months in the beginning of every new page, and then the dates, right? And then you might have more than one transaction on the same date. So if it's different transactions, you just repeat the date, not the month. You always will skip lines between transactions, skip a line between transactions. We will put accounts and descriptions in this column. This is posting reference. We will use it when we post to the ledger. And then you have 2 money columns, debit and credit. So our transaction, these are, by the way, the same transactions we looked at using T accounts in chapter 3. So on November 6th, Trayton Ally withdrew $100,000 from personal savings and deposited it in a new business checking account for Ally's consulting services. So on a piece of paper, I do my T accounts, right? We did them in chapter 3. So I will put here, so we have cash and I have capital, right? Again, nobody will see T accounts. These are just my tools, capital. Trayton Ally, capital. Cash is an asset plus minus, capital is equity minus plus. Both accounts go up, but cash is a debit, 100K. And it doesn't matter if you use dollar signs or not, how your T accounts look like. It doesn't really matter if you abbreviate because nobody sees them. It's just a tool. The journal is the official record. So debit cash, credit capital. I have this, so all I do right now, I just transfer it to the journal. So which account do I debit? Cash. I list account that I debit first at the margin. There is no, look, I do not indent, I do not tab. I enter it at the margin, cash, and then on the same line, we enter the amount, $100,000. So we take this cash, guys, and debits always go first. You list the account that you debit first. If you have multiple accounts debit, you list all of them and then credits. And then we do capital, which is credited. Enter the account to be credited. Notice what we do. We tab, we indent, right? If you're doing your work in Connect, it will do it for you. But remember that I don't even need to look at the amount. I know which account is debited, the one without indentation, and I know which account is credited, the one that is indented. And then I put on the same line the amount in the credit column. And then, guys, I indent more. So here it should be indented more. Let me indent it a little bit more. And I write the description, right? So I write so-called explanation or description, which doesn't have to be a full sentence. Investment by the owner or the owner's investment. And then, guys, if you have any kind of source document numbers, if they're given to you, like here it's given memo number. Let me move it right here. Make it look pretty and good. All right, and so guys, I have a memo here or any other source document. If it's given to you, you put it right here, right? And it might take more than one line. That's it. So put the page number first, and then you put the date, and then you put the account and the amount to be debited, the account and the amount to be credited, and then the description. Okay, now I will go faster. November 7th, LI Consulting issued check to purchase computer, other equipment. Again, guys, you're using T accounts. I need you to use T accounts unless it's very easy for you, right? And when you do T accounts, it doesn't matter which one you put first or second. So I know cash is impacted and I know equipment is impacted. They are both assets, so they have a normal left or debit balance. I pay, so I always say instead of the company, just say I issue check. That means we're gonna credit cash $5,000 and we're gonna increase debit equipment. So I did my analysis. There it is. How do I journalize it? I put equipment first. Whatever account you debit, it doesn't matter if the account goes up or down. What matters is that which account do you debit. Equipment goes first in the amount, cash goes second, and you see it's indented, and then we write the description, and it was given to me. The source document was the check number. Bought equipment, purchased equipment, check number 1001, and so on so far. So here we purchased equipment on account for 6,000, debit equipment, credit AP, write the description, there's the source document, invoice number, and then if it's an electronic system, the actual accountant or an auditor can click on this invoice and see, was it indeed an invoice from Office Plus due in 60 days, and was it for $6,000? So there is that audit trail where everything is connected together. We purchase supplies for whenever it's check number, that means cash, debit supplies, credit cash, write the description. And guys, we will list this one after another, and I always say skip a line, right? Skip a line after each transaction. Skip a line. On November 30th, I paid Office Plus partial payment against the invoice. So both accounts go down. Again, look, if I'm going to do the T accounts here, and again, I will put cash first, doesn't matter which T accounts. I put accounts payable second. And guys, cash is an asset, plus minus. Accounts payable is a liability, minus plus. So I write a check, meaning I decrease cash by 2,500 and I pay off accounts payable. So both accounts go down, right? But which do I list first in the journal? AP goes first. Why? Because it's a debit. Does it go down? Yes, indeed it does, because liabilities decrease when we debit them. And cash goes second, and it also goes down. Both go down, but the one that is debited is listed first. So remember, in the general journal, always enter debits before credits. Never flip them around. I wrote a check to prepay rent for December and January, debit prepaid rent, credit cash. Eli's Consulting performed services, which means I performed services. Again, this phrase performed services means revenue, and then it will say either for cash or on credit. If it's for cash, we debit cash. If it's on account or on credit, you debit accounts receivable. So here, debit cash, credit the revenue account called fees income. Again, both go up. If you do the T accounts, you will see that both of them go up. But the way our normal balances work, one is debit and one is credit. I perform services on account, so instead of cash debit AR, credit fees income, and then indent and write the description. Received 6,000 in cash from a credit client on account. I'm collecting cash against AR. Again, there is no fees income anymore. I already recorded fees income once I performed the service. Now I am just simply collecting on account. Cash goes up, debit, AR goes down, credit. I paid 8,000 for salaries. This is the debit, so expense is debit, cash is credit, and then the description. And I paid the utilities bill, debit the utilities expense, credit cash, and write the description, paid monthly bill for utilities, check number is your reference. And then the last transaction, the owner withdrew 5,000, debit drawing, credit cash, write the description. Okay. So we went through these simple transactions. In many instances, that transactions will require a compound entry. It's a journal entry that will have more than one debit and or credit. Especially, you will see it when we cover chapters 10 and 11 in payroll, and our transactions will include quite a few debits and credits. Because in one transaction, many things are happening, so this is called compound, right? Like in English, a compound sentence has two components. If you study well, comma, you will earn a good grade. A compound word has two words joined together, ice cream, football, basketball, baseball. In accounting, we will have more than one debit and or credit. So here's an example. We purchased equipment for 5,000, issued check for half, and the rest we pay the balance in 30 days. It's like, we looked at this transaction, right? You make a purchase, you pay some cash, it's your down payment, and the rest you put on the credit card, and you have to pay it back in 30 days. So here we have one debit, equipment, but you have two credits, cash and AP. Look at the format. Debit is at the margin, credits are both indented, the same indentation for cash and accounts payable. And then you indent a little more, and you write the description. Okay, so hopefully it makes sense. Remember, no matter how many accounts are affected by the transaction, your total debits must be equal to total credits. And here it is. 5,000 is equal to $5,000. All right, the next step is posting. And again, guys, here I showed you journalize and then you post. In reality, you do it simultaneously, right? You have to do it at the same time. You journalize one transaction, then you post it to the ledger. And in this chapter, you will be doing the ledgers. In chapter 5, 6, you will be doing ledgers. Beyond that, we will skip ledgers. They are always done, but there is not much thinking. It's just a lot of tedious work, a lot of copying. So, ledger account form. This is the example of the ledger we're going to use. We will have a separate sheet for every account. Cash will go first, account number at the top, and then you have date, description, posting reference, debit, credit. The description column, please leave it blank. We will only put a word or two there in chapters 5 and 6. Right now, leave it blank. Don't write anything there. And then, guys, you have a running balance. This is called also the running balance ledger form. You have a balance and you have debit and credit. And guys, for cash, the balance always has to be debit. So like we don't even need this column, and some ledger forms don't give it. So for cash, this is your T account right here. This is where your T account is. This is plus, this is minus. So if I have an entry on the debit side, plus side, my balance goes up. If I have an entry on the credit side, your balance goes down. It still remains a debit balance, but it's now 100,000 minus 20,000 is equal to 98,000. So you run balance just like that. Your balance can never be for cash on the negative side, cannot be credit. And then I write another check for $8,000 for whatever expenses or whatever I purchased. So I credit cash, and then what happens to my balance? 98 minus 8 equals to $90,000. Guys, if you, and I know most of us don't do it, but if you balance your checkbook, that's what you're doing there. That's your balance in the checkbook. And then I perform services for cash and I get $2,000. So what happens to the balance? If I debit the account, my balance goes up $92,000, and so on and so far, right? Okay, so this is your ledger, very easy to use. You have account name and number. You have columns for date, description, posting reference. And guys, posting reference here is journal page number 1. Again, we're providing the audit trail. We're telling future auditors where information comes from. Where does it come from? It comes from the journal page 1. And what we're going to do in the journal, in the posting reference column, we're going to let me go. So in the journal, guys, in the posting reference column, you're going to write the account number. So like, for example, when you post it, what's the account number for drawing? 302. What does it mean? It means I took this amount and posted it to account 302 in the ledger, and we call it cross-referencing. And cash is 101. So you can see on the journal where the entries went, and you can see on the ledger where entries came from. So you have columns for debit, credit, debit balance, and credit balance. So these are 5 steps in posting, very formal, but like I said, you just put the date. Description is not necessary, right? Don't worry about description. You put the general journal page in the posting reference. You enter the debit amount or credit amount, and then you run the balance. And you put on the journal, you enter the ledger account number in the posting reference column. So guys, if you look at this 5 and if you look at this 2, this is called cross-referencing, right? We cross-reference both books, the journal and the ledger, cross-referencing. Okay, so again, here we are. This is my entry in the journal, equipment, and I am posting it. I copy the date. Then we copy the page number, leave description blank. Then we look at equipment. It was a debit, so we enter it as a debit. And then we run the balance. It's a debit balance. And then we take the account number, 141, and we put it in the column posting reference in the journal. So it's very mechanical, very easy to do. Don't worry about it. Memorizing the steps, it will become natural to you. Okay, the general ledger accounts. In the general ledger accounts, the balance sheet accounts appear first, right? So what we talked about in chapter 3 in regards to the chart of accounts, which accounts are numbered 100? Assets. So that's how they're going to be situated in the ledger. The asset accounts go first, and then they're followed by liabilities. They're followed then by capital and drawing, and then revenue, and then expenses. So the first 3 are balance sheet accounts, and the last 2 are the income statement accounts, and that's how they're going to be located in the ledger. This order of accounts speeds the preparation of the trial balance and the financial statements. Okay, the last objective, correct errors that we make in the journal or the ledger, which happens. Sometimes errors are made when we record transactions in the journal. We never erase. This is what you have to remember. You cannot delete if you're using computer, or erase if you're using paper records. You have to record a correcting entry to adjust the accounting records and resolve the error. I always, and it could get complicated. Sometimes it's a little tricky to think about those correcting entries. If you're taking the class with me, you will have 1 homework assignment, but I do not include this type of problem in your on your test. You might have a multiple choice question, but not the actual exercise or problem. But here the goal is to erase the error. So I have 2 goals. With a correcting entry, I need to bring my error to 0 and then update the necessary accounts and or amounts. So, like I said, do not erase anything. And here is an example. On September 1st, an automobile repair shop debited office equipment rather than shop equipment for 18,000 by mistake. So the other part of the transaction, which they don't even tell me. So what did I credit? Either cash or AP was correct. So you don't need to touch it. What you need to do, you need to bring the error to the zero. So I need to eliminate office equipment. How do I do it? If I debited the wrong account, now I need to credit that account by the same amount, which will bring the error to zero and update the necessary accounts and amounts. So I will debit shop equipment by 18,000. This is what your correction entry should be like. This is the original entry, and I don't touch cash, right? I don't touch cash because it's fine. All I need to do, I need to eliminate office equipment. So when I post this 18,000 as a negative credit to office equipment, its balance becomes zero, and then I debit the correct account. So hopefully it makes sense. Again, please practice here. These correction entries could be a little challenging. Okay, and this concludes chapter 4. These are the key terms that we studied. Again, we looked at steps 2 and 3 of the accounting cycle. I defined 2 sets of books, the journal and the ledger. And guys, we learned how to journalize or record transactions in the journal. We also talked about the compound entries. And then we looked at how to post from the journal to the ledger. The last thing we did, we learned how to record a correcting entry. Have fun studying.